Okay. Well, it is a rainy day in Utah, and we got our first snow here. So I thought, well, not down here in the valley, but up in the mountains. So ski season's on its way. But I wanted to work on presenting this playbook to get another rep in for myself and also to share this with anyone in the community or in YouTube land that's actually watching this. And I'd be interested to see what you guys would grade this trade. And I will give you my comments on what I think this was at the end. But to give you some context, this is an opening range break trade. It's a day two continuation setup, and the catalyst is delivery numbers from Tesla, and it was a sell the news event. And this happened on Friday, October 4th. So we've got some zero DTEs involved. So it's going to be fun. So the bigger picture, the Fed delivered a 25 basis point cut on September 17th, sparking a rally that moved the Qs into the 590, 595 zone. And then momentum carried it through to an all-time high of 603. But sentiment shifted as Powell cautioned about markets becoming too highly priced. We had a reversal. We erased some of the gains. And we've been kind of moving around in this range. And more lately grinding up towards the top. And then finally gapped out and made a new high. So if you look at kind of the intraday, the Qs gapped up actually to a new pre-market high of 608, so well above that 600 range, but kind of faded into the open. We had this little down move going into the open and put in an opening range. We failed, and then we tried to push up again, made a lower high, and had a really, really nasty sell-off around 1 p.m. You can see the volume coming in was as high as the opening volume. So this was a significant sell-off. You saw the VIX spike, and it looked for a short period of time like maybe the market would crack and we'd see an even deeper sell-off going into Friday afternoon. And we still might on Monday, but we did close in the bottom 20% of the range. So we pushed up a little bit, couldn't even make it to VWAP, and closed in the bottom 20%. So some interesting price action, and we'll see what that means for Monday. So on the VIX, we've been trading on the daily and the VIX kind of in this 14 to 17 range. We have had a couple spikes up in September, FOMC uncertainty and geopolitical tensions. And then we also had one in August after there was a little bit of an inflation scare. So we had inflation spike above 20 in the VIX, and we had this kind of FOMC spike. But overall, we've been kind of consolidating and almost making a wedge in the VIX. So maybe we'll have a breakout and a huge increase of volatility going in the end of the year. But more likely, we'll just kind of chop around and be less volatile. So we did see that spike on that sell-off and volatility. We didn't quite hit 20, but we got up to 17, I want to say 17.5 in the afternoon. So there was definitely an increase in volatility in the afternoon, which was a tailwind to this trade. So Tesla, and we won't spend a lot of time on the fundamentals of Tesla because we talk about them quite a bit, but our vol on this day was about 1.3, which, for a $1.4 trillion stock, you don't really see 2 or 3 RVOL all that much. There is, a $3 billion float on the stock. So pre-market, we did about 2.8 million shares, and typically I look for at least a million to show that Tesla potentially is in play, but more recently that's been pretty common. But I think 2.8 is definitely elevated. It's about 3% of the overall float or overall average daily volume if we did 3.5 million by the open, and the ATR is about 16. And the catalyst, so the day prior to this trade, Tesla reported delivery numbers of just under 500,000. The estimate was about 450,000. So this was a pretty decent beat of delivery numbers. That's the good top line number. And I think people got excited, which is probably why we kind of ran up into it. But the surge was fueled by a rush of U.S. buyers looking to buy cars before the $7,500 tax credit went away on September 30th. And so, this could be more of a one-time increase in sales than the start of a trend. And so, there's reasons for bulls to be excited, saying, "Oh, Tesla's growing, and this is pile in." But for bears, if they're front loading sales, that means the next few quarters could be worse. Actually, right? They're pulling forward demand, and so there was a lot of talk in my pod and traders that I trust about the potential, especially since we ran up quite a bit into into delivery numbers, that this could be a sell the news event. So I was had a short thesis, but I wanted to wait until price action actually confirmed. And it did yesterday. It did the day before this trade, because it was a pretty strong sell-off, which we'll talk about in the technical analysis. But that's the catalyst. I would say this is like overall, like probably a 7.5. I don't know. 8's pretty strong, because it could really cut both ways. And I would classify this under a confusing catalyst. Like, it can be interpreted either way. It's not like they double beat and raised and, pre-announced and new products and all this really cool stuff that you really can't say like, hey, this is bad. You could find bad in this, you could find good in it. And I think that mixed catalyst is certainly, kind of brings it down on the list. So let's look at the technical analysis on this stock. So on the weekly chart, Tesla's been, moving around, but also kind of in a bigger picture, doing a whole lot of nothing. Kind of a lot of sideways price action with kind of flat and crossing EMAs up till the run up to the election. As y'all might recall, the Musk-Trump bromance and the thought that maybe this would help Tesla really drove up the stock to all-time highs. We hit 488 in December, post-election, party for Tesla. But then we consolidated and started to crack. And, it was basically over involvement in the government. And like, this is when people were like burning Teslas and like, because like, how dare Musk like Trump? And so there was a lot of political fallout from Trump's relationship with Musk. And, on top of that, we certainly had the market selling off in this time frame over tariff fears. But I think the big driver was the concern about Musk like not putting enough time into Tesla. And so we did have a little bit of a rebound. And then we had a blip-ish sell-off when Musk and Trump had their falling out. Since then, we've kind of consolidated in this wedge formation with 350, 360 being resistance. And about 4 weeks ago, we broke out and we're up pretty big after that. And so, we can see this on the daily, which is a little busy. So the 470 high that we made right on the announcement of the delivery numbers is about 30% above the breakout zone, which was again like that 360, 358 level. We've been kind of wedging up into, you can see it more clearly in the daily. We broke out on pretty decent volume and had this big up move, and then we've been consolidating for a number of days, 3, 4, 5, 6, 7, like I think it's like 2 weeks, maybe even 3. And then we broke out kind of running up again into delivery numbers. But what's interesting is right here, the arrow, not these big volume bars, but the breakout is actually this lower volume bar, which is kind of an average volume. So we broke above this 440 level with average volume after we failed from it, kind of tried again and didn't do well, kind of held there, chopped around, and then we broke on like unexciting volume. And then we had delivery numbers and we sold off, and our volume was like, I don't know, 20% better than the up volume. So clearly a lot of people in this consolidation decided that this breakout wasn't going to work and sold it. And so kind of an interesting daily setup. We have basically a daily failed breakout, right? And this is actually not just, this is day 2 of that daily failed breakout. And so on the 15-minute chart, you can see this failed breakout clearly. We have the day leading up to the delivery numbers being a kind of big opening drive and then kind of sideways consolidation at the highs. We gap up into delivery numbers and then we get stuffed on those numbers. And then we have a really, really high volume 15-minute bar. What is that? 16 million shares done in the first 15 minutes after the announcement, and it's all selling. And then we basically have a trend day to the downside, and we try to bounce, but it's really not a strong bounce at all. It's a very weak, muted bounce. We have a tiny gap up. We hold that 440 level, which if you look back to the daily, this 440 level is right here. This is the breakout level that's been acting as resistance for 2-3 weeks. We have this like box on top of box here. We have this little box here, second box at the top of 440. We break out of 440. We fail below it. And now we're trying to gap above and it's acting as support going into the open. We fail 440 at the open. We have a big opening drive down. We consolidate in what I would call a minimalistic big dog, like 4 15-minute candles. So a 60-minute, really like to see 75. And I'd call this like an upward sloping big dog where we try to pull up, we fail, make a new low, and we flush down to lows. Consequently, that weekly or daily 417 level that we talked about, which is basically the bottom of this whole consolidation, becomes support and the end of the move for yesterday. And so really honoring technical levels quite well. And so on the intraday, we can see again, fail below 440 at the close on previous day before this open, find support around 336, gap up, hold the 440 level, fail at the open, and there's that 417 bounce level. So on the 5-minute, I thought this was interesting is that, the 440 level, we kind of made this 5-minute opening range, 1, 2, 3, 4, 5. There's our 5-minute candle. We chop sideways within that range, and it happens to be 440.66 that's holding. And then we fail below it, retest, and then start consolidating below the 440 level. 440 was support, has turned into resistance. And we, sorry, my dog wanted to go out. And then we break that, never to see it again for the day. Break that 438, and we're off to the, trend down. So my trade strategy, which admittedly I think could have been a little bit more robust, was Tesla second day trade. Look for a break below 440 and consolidation below that level to get short. If the market is weak, then that's a check in favor. So this definitely could be more robust, and it's one of the things that I really need to work on as a trader is building even better trade strategies. So this is my 15-minute ORB strategy. So I'm looking for R vol over 1.5. I'm looking for a tight opening range, less than 50% of an ATR. Less than 30% is ideal. It doesn't happen before 9:45. And, if you look at this trade, the 15-minute candle was $8, which, Tesla's ATR is over 16. So that's less than 50% of an ATR. So that's a check. Our vol was 1.3, which isn't 1.5. But as we said before, this is a really thick stock. There's a lot of shares of this stock around. So to get us above 1.3, 1.5, like, maybe on an earnings day where everybody's looking at this, but for a second day continuation on a failed breakdown, we probably wouldn't have gotten above that unless we really got like secondary breaking news, which I think, could have totally happened yesterday, as we could have had like a pile on and someone else say something bad, but that didn't necessarily happen. We had the market as an accelerator, and we'll take that. And so we did have a breakdown at 10, which is after the first 15 minutes. So it's actually technically like a 30-minute opening range break. And then we found support at 15-minute low, and we broke at the third attempt. So if you look at this close, it actually took 3 attempts, which I talk about in here as kind of a check in favor to make this the best entry. So execution. So this is where, there was a lot of good lessons here. So I personally think I undersized this at my initial entry being 5% of a daily stop. And I took it on the 5 minute opening range break. So that's that break that we talked about here. So I entered right here basically. I saw the volume. I saw this 5 minute. I saw 440 break or 440.56. And so, I thought that that's worth putting 5% of my stop. I think that, this is not a C trade. We have a catalyst set up and trade, and it's a second day play, and it's opening range break, which is my trade. And so I think that's worth more than that. Everybody says they underside every trade that works, but like this is legitimately like it should have been 15. And then I did add on the break of the 15-minute opening range. And then I struggled on this trade with 0 DTEs. So, trading a fairly small account or a small stop, actually, it's not a small account, but a small stop. Even a couple of 0 DTEs on Tesla, to add a reasonable amount of space for time decay, which is very radical in these instruments. Really, I didn't do a great job of that. And so I got chopped up and took a couple of losses, probably because, I use a hard stop with these option trades and got stopped out twice. And again, it's hard to size these under like a decent amount. And so all of a sudden, like, I think I lost 15% of my daily stop, like getting chopped up on the options trade. And so I think in hindsight, I was early, and we're going to talk about this in great detail in the options pricing page. But I think, the lesson, like Max, says the king is 0 DTEs, like 50%, like is what you have to risk. And that's hard with a small account with the Tesla options are like, $1.40. So you're risking basically $150 on like, a 0 DTE trade. And if your stop isn't that big, like, it's not for the faint of heart, but if you want to learn this, you got to figure out a way. And I think, for me, a minimum is 2 contracts because again, if you have one, you can't partial. And the problem is these things will degrade so quickly. You really have no option to take profits, and you can see this big round trip issue with them. So, and maybe that's okay. Maybe I should just tolerate more round trips. I don't know. What do you think? Add your thoughts. Here comes the dog. It's kind of an interesting one. And so, what I did is I ended up, go back to the stock. I sold the stock in here, which I think was a good victory in terms of I took 0 partials. I just held all of it for a reason to sell. But I don't think there was a reason to sell as much as I did. And so I should have held probably 80% of it at this point to see what would happen, because this is really like a day 2 continuation and potential meltdown. And when things break a range and fail, usually they hit the bottom of the range. And, the bottom of the range for this was 417. So I don't know why I was taking profits at 430. That's 15 points that I left on the table to take no additional risk other than just to sit in the trade for a while and just be patient, right? Because I had 0 risk at that point. My stop is easily a break even. And if I took some profits, then I had profits too. So that was not good. And so what I did is I chopped into 2 move to moves, which, I think has been okay up till now in my development, but I really don't think that's appropriate for where I'm at in my trading career. My second one was this big dog where I got in here and caught this down leg, which actually was a really good 0 DTE trade. But the better trade would have been just to take appropriate sizing and hold it. So, lesson learned, or, another lesson in my development. So, and I like these lessons because they're not as expensive as the losing lessons. They're the winning lessons, win less lessons. So what I should have done is done 15% of a daily stop in equity on the 5-minute opening range break. It's a catalyst, it's a settled trade. It's my trade, doing exactly what it should do. And I could have easily done that. And then I could have added 30% of a daily stop with options at the 15-minute opening range break. either at the initial break or even at the second chance if you don't want to sit through it and just see the acceleration, right? Because then you really do have that see it moment. And I think that's the other thing that I need to work on is like I'm getting it in the right spots, but like sometimes I'm early, which is okay, but it hurts to sit through that and it's unnecessary because I just need to wait to see it because it happens and there is a see it moment in here. And then cover 50% of the stock after we make a true backside, which, you know, we make a low here, we make a higher high and a higher low. And so right in here is the time to get 50% of that position off and then leave the rest to break even, which would be up here, even better than break even, maybe a little above VWAP, and just see what happens to the end of the day. And in this case, you know, cover on the second backside, which is in here, and that gets you another 10 points, you know, on 15% of your stop if you did 15% in equity. Sorry, so 7.5. But either way, it's a good trade, better than what I did. And on the options, like here's where I got chopped up. So I did some in and out mistakes on these small little things, and I sold out twice in chop for, you know, a $50 loss and a $35 loss. So it's an $85 loss, which again with a small stop, you know, is not great. And then I bought 2 puts at the right spot, but I sold one way too early. And then I sold the other one too early. So I didn't manage it well. And so let's talk about ideal. So I know this is kind of busy, but what I should have done is left all this out until the opening range break. And then bought my 2 contracts. It basically would have been at 26% of a daily stop with a entry at $1.40 and my stop at like $1. It's roughly, you know, 40% risk. Still a little tight for a 0 DTE, but like, you got to push it a little bit, especially if you see it. If you see the acceleration, the option. And then, you know, the reasons to sell or the reason to partial. So Max sells his at a double, but again, he's trading a bigger account. So like it doesn't matter as much if he's getting that 1-to-1 and he can take something off on the way down. I think the rule that I'm settling on is after you reach a double, you don't sell before you reach a double. You sell after you reach a double and momentum dies in that leg. So you start to see degradation in the price and it starts to drop pretty quickly. But you got to be far enough above the double that you're not going to go below the double. So in this case, the double would have been 3, but you got up to like $3.50, almost $4. And then it starts to die. You probably out like $3.25, $3.30. Right? So you're better than break even if you went to 0 on the second one, which you probably wouldn't do. And then you tolerate your open P&L going from $185 down to 50. So you need to think about that needs to be tolerated because, you know, your P&L got cut by 75%. And but if you hold and you sell into the next spike, you know, basically you're out with an 860 on the second one. So, which is, you know, 900%, or a total win of 1,045 for 13 times your risk. You're risking $80 and you make 1,000. So, you know, that's the 0 DT trade that should be happening. And, you know, that's why I continue to playbook these 0 DTE trades and talk transparently about the pricing and what I'm putting on there because, like, I don't know how to get better at this other than do this the same way we do a stock. So that's what I do. And then what I actually did is I did do a capitulation trade here, right? This like second leg momentum, the big dog. So it comes up, breaks trend. And if you look at the tape here, there was just massive selling. This was not, couldn't even get to VWAP. And then it puts in it basically breaks trend, right? It trends down, trends up, breaks trend, and then starts to put in a series of lower lows and lower highs, which we know is a trend. And then ultimately it sags below and fails on volume and puts in a final leg where we get down to, you know, 417 area basically. So we get another 10-point drop, which I hit this with puts and accidentally took 100 times my size, and so I made a lot on that trade, but it wasn't intentional, and I could have gotten blown up with it. So it wasn't the best. But again, it's the kind of mistakes we like. It's mistakes that don't kill you, but they still make you stronger. So, but here's why I think this trade is just not as good. It's later on, so these options are cheaper, but like they could also go to zero much faster. And basically, if you do the same kind of like sell and momentum stalls, buy 2 contracts, momentum stalls in a double, you're getting them at 62 cents, but your stops really got to be like 30 cents because these can go like down like that. I mean, look at how it died here. And, what you end up with is like you get to $1, but you're like, I'm not selling $1. Look at the momentum here. So when you get to like $2, you're like, okay, well, it's still got momentum. And then you probably get it in the 233 range, for one. And then the second one, yeah, maybe you hold it for another, an hour, and it gets up to $4, $4.50 at the top if you top ticket. And so you end up with basically like, I don't think my math is right on this. 62 cents minus $4 minus 62 cents. You get 300. So you're getting 338 plus 233. My math was wrong. You're getting 571 minus 0.62. You're getting 5. So you're actually getting double it. So you're actually getting 8 to 1. So I take that back. It's not that bad. So you're getting 8 to 1 on that one. So it's still not a bad trade. I mean, you're getting 8 to 1 to wait like an hour versus like the whole day for 14 to 1. So, maybe it's better. I don't think we'll get into the tape here today because this is already going kind of long, but you can look at the tape. And I would encourage you to look at the breakdown. And I'd also look at like later on, I actually tried to trade this as a backside. And if you looked at the selling kind of near the highs where it failed below VWAP, it should have gone to VWAP and it didn't. And not only did it not go to VWAP, the sellers just stepped down so methodically. The volume came in. It was aggressive selling. And it should have been a clear reason to look for the second continuation leg. And honestly, I missed it, which is why I caught it late, because you could have gotten short right there. Like, it would have been a great risk to reward trade just to catch, basically, it's not really a stuff, but the rollover below VWAP. And that was a really good entry for the big dog. It's kind of the pullback big dog, which we can talk about another time. So technology, I use a custom indicator from Thinkorswim for the opening range break. It draws it, which is nice because I don't have to like look at the 15-minute candle. It says there's the low, there's the high. Easy to calculate the percentage. And then I do use a trade. I'd use ORB scanner with voice alerts. Again, not for this trade because this was a trade in my plan. Oops, I let it slip out. I think this was an A. And I didn't trade it like an A. I traded it like a C, maybe a B. Because I shouldn't use options with C, but we'll call it a B. And I think, what I did well is good stock selection. I expressed the trade idea with options and stock, and I held the core stock with no partial profits for reason to sell. That early trade leg was great. I just didn't make enough on it because I chopped up a bunch in the options mistrading. And so I was undersized. I was too jumpy with options. I need to wait for a see it moment with the options to push the size. I need to look for a trade to hold much more often because it's more profitable than chopping up the trade into 2 trades. Because, stacking the trades, like I could have taken the big dog with, another 15% on top of the 30% in options and, or used unrealized profits to really stack up my wins. So I need to practice better sizing and patience. I need to be more specific with the actionable trade plan. I need to add sizes with separate trades while holding a core. I need to get better at recognizing and improving my trades to hold. Elite traders capture the move, not a tiny slice. I mean, if you think Justin was talking about how shark trades a while ago, and he just holds it and captures the whole move. He's not doing this like in, out, the side, partial. Like, that's not what you need to do. And, and I'm still doing that, and a lot of people are. But I think, to go back to the execution, 15% in equity. Now you have unrealized. You still haven't taken any profits, and you're adding 30% of daily stop and options, but you have unrealized, so it's not really 30%, right? If it all dies, you're losing 15%. And let it run. Cover some of the stock into here. And probably add another 15, maybe 20%, because you have so much unrealized on this capitulatory leg. And then you're talking about multiple daily stops, right? And you're not really taking on a lot more risk. So there's work to be done. But I think this is progress. In the past, everybody says they want to size up. Oh, I should trade it bigger. But like, what does that mean? What does that look like? How do you do it? And I think this is a good roadmap to what I need to do next to size up. So thanks for listening. If you are, leave a comment, because these are fun to make. They're good for me. But if anyone's watching, I would love to hear it.